You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Hello from Houston, Texas. I'm actually sitting outside of one of our investment partners' apartment complexes on the west side of Houston, but wanted to do a quick intro for part 2 of my podcast with Jake Clopton. We had a really great conversation, and what's really cool about these podcasts are Jake and I, I hadn't known him before. We had a great conversation, and now we are talking about doing some more formal business together, where we can put some deals together, raising equity, helping some of broker some deals. So super excited about that. Hopefully there's more to come in the coming weeks. But with that said, enjoy part 2 of my discussion with Jake Clopton.
I've probably made my most money, frankly, after 2008 buying non-performing mortgages. So I mean, during the crises, they've all been painful, but I've always, found a way anyway. So, but certainly would prefer not to have the stress of that, both for myself and for the the economy as a whole.
It's certainly time to enter a market, right? I mean, it's hard. I mean, I started my business, which is effectively a credit business, during a credit crisis. And I mean, if I had tried to do this when things were great and things were going along and everybody was happy, it much more competitive. It would have been a lot harder. But because I started what I did with somebody who had no experience in what they were doing during the credit crisis, it was much easier for people, to get people to take my phone calls, because a lot of people had left and there was opportunity. And it's definitely the time to, take risks and take opportunity. I mean,
that's a really great point. And as I think even on the borrower side, when things are good, you've got your 1 or 2 loan guys. You don't even need to shop. When it's hard to find debt, everybody's open to finding another option or somebody who may have another lead.
Now, before the run up in rates, our business is about like creating capital markets around every deal, right? And we talked to like 150 lenders on each one. I would pitch a deal to whatever group of lenders it was, either banks or private debt funds or whatever, right? And you'd probably get, half that would say no and half that would give some sort of terms, right? Now it's like, it's like 90% that say no and then 10 that kind of give you term, or maybe 5% give you terms and another 5% maybe the deal works out, especially when you're dealing with local regional banks. I mean, I would say about half of local regional banks are just dry, their deposits. It's a really interesting phenomenon going on when we go to, get loans from banks. They ask you for loans in return, which is basically the form of deposits. It's definitely a different world than it was just a few short years ago.
So really the Fed raising the rates just sort of took the commercial lending out of the market just because it sounds like the commercial banks can't afford to lend because, I guess.
Some of them. No, it's absolutely right. No, some of them can't afford to lend because they literally don't have the money on the balance sheet, right? By raising rates, they suck liquidity out of the system. And after COVID, a lot of these local regional banks were very, very flush with deposits because of a lot of COVID money, PPP loans and all this stuff. And they were huge deposit banks. But a lot of that has gone away. And also just, the Federal General sucking, liquidity out of the market. It's really like a tale of two worlds with some of these banks. Some of them are fine. They're liquid. They're still lending. They don't have a problem. And then other times I'll go to a bank and I'll say, hey, I want $10 million. And they say, okay, well, we need $3 million in deposits to be held at the bank that we can't pay interest on to lend you the 10. I'm like, okay, no, that's not how this works. The answer I get a lot of times right now.
Yeah, that's great. And that I guess, it makes sense that a lot of these non-bank lenders have taken a lot of market share. I mean, for better or worse, obviously some of them have made the press like Arbor, who, we'll see how they navigate things, but seems like the gap has been filled by essentially originators that securitize or really just work the Wall Street model of probably have a line of credit with one of the big investment banks, then sell the loans into mortgage-backed securities to some extent.
I mean, I would tell you, man, like, I don't know. I don't think there's going to be a banking crisis. I don't, because there's a lot of really well capitalized banks. But, just by being in the market and talk, all I do all day long is talk to banks, definitely, and I'm not naming any names here, but there's definitely some larger banks out there that are absolutely in trouble and just aren't really saying anything. Some smaller ones too. But I think what's going to happen is just consolidation, right? Which always happens. Like, the larger banks will just get even larger because the FDIC will cram these smaller ones down their throats, and they'll become more liquid. And this, will come out of this thing, and there'll just be a few fewer banks. So put it that way.
Yeah,
but there's definitely some distress. Some of these banks out there that has not hit the market yet.
I'm surprised more hadn't hit when rates initially jumped last year. I mean, we had accounts with First Republic, and they were surprising to me. I mean, they didn't really make terrible lending decisions, but they had, frankly, too many high net worth clients that locked in 2.5% rates for 30 years, and that dislocation in the market where rates are at 5 and they've got their book at 3, mark to market, that's 40% drop, and it was probably one of the unintended consequences. It's like the butterfly effect sometimes. The Fed trying to rein in rates, and they I think created havoc in some areas they maybe didn't even expect.
Yeah, and I mean, the thing is, if a lot of times, like, they just hold those, right, they'll get the money back. But in the meantime, if you have to mark those in market, that's a pretty big hit on your balance sheet.
Yeah, absolutely. Well, let's pivot to insurance. I just hear a lot of noise on insurance. I know it's personally killed some deals that were potential investment acquisition opportunities for us. And I know it's caused a lot of pain in the market. What have you seen? Like, how much are rates really going? I mean, I know it's asset class dependent, but really just curious your thoughts on really what's causing the havoc in the insurance markets. How bad is it, and where do you see it going?
Well, it is to a degree asset class dependent, but also to a degree it's not, right? Because if you think about the way that just the insurance industry works, is they spread risk, right? So you spread risk from the risky guy to the less risky guy, and you kind of even that out. And then, on average, the insurance company charges more in premiums than they do in payouts. I mean, here's a good example, man. You can look this up, and I forget the exact percentage increase it was. And also, for some reason, I can't remember what insurance company it was. But if you look over in California, they just approved, I believe it was a 32 or something % increase in homeowners insurance prices to keep a very large insurer just active in the state. And that's quite a jump. That's going to filter through the market. That's going to make everybody else raise their rates 32%, and that's going to filter through the commercial market as well. I mean, really, what's going on is, it's twofold, right? I mean, obviously, there's a lot more, just environmental risk out there. I mean, I'm not going to talk about climate change or anything like that, but I think there's been a lot more, environmental property loss than people were expecting to happen, just because of weather and everything that's going on. Also, input costs to repair, these properties is substantially higher. I mean, that's the other side of the equation, right? Because when insurance pays out, they have to pay out the amount to fix these properties. And we've all seen construction input costs fly through the roof. So you really, you're getting more losses, and those losses cost more. And when you have to, spread that risk throughout the market, it's just a rising tide, and it pulls all these ships up. And you don't think, we're near the end of it. Just as an example, again, this California thing, but I think that's gonna, have effect through the entire country. So it is really a problem, right? Because insurance is what it is. You're not getting financed without insurance. You're just not, right? So it's necessary. And it absolutely, affects the value of these properties, and then also, the debt serviceability to be able to finance them. This is why we started our insurance agency in the first place. I would say 10 years ago, insurance was one of these things where you just renew it. It goes up a little bit. When you do your pro forma, you slap 3% on insurance, inflation year over year, and that's an afterthought, and it's annoying, and nobody wants to deal with it. They don't really understand it in the first place. You have an insurance guy that takes care of it, Now you can't really do that. I've seen so many people, and okay, here's something that's really going on in the marketplace, which is pissing a lot of people off. They're getting their insurance renewals, and some of these like incumbent agents are sending them their insurance renewal, let's say like 2-3 days before the thing renews, right? And it has a 200% increase in premium. What do you do, right? You got 3 days. You won't have insurance if you don't renew it, but you just got hit with double your premium. And I've just seen a lot of people that just have to take it, right? Because if you don't have insurance, that's a covenant default in your financing, or God forbid something happens, and so you get kind of stuck. And I'm seeing that a lot happen out there. So and then also I'm seeing people kind of this idea of just sticking with the same guy and not really shopping it, kind of going away. I think the days of just auto renew are over, and every time insurance comes up now, you have to take it to the market and really market the thing as much as possible. That's one thing I think people don't really understand is that, the cost of your premium, varies greatly, very, very greatly, depending on who the actual insurance. I mean, we'll take things out there and, market it to, all these different insurers. And I mean, some of them are, 50% less than the other for more coverage, because a lot of it just depends on, if this agency wants to be in this market or how their book looks or stuff like that. So, yeah, I mean, you definitely need to take a very thoughtful and, planned out approach to insurance today. And really, you've got to approach this like to give yourself enough time to appropriately market it. You can't wait 2 weeks until your premium is going to come due anymore. You've got to really start taking out there about a month and a half beforehand. Because the other thing that's going on is these insurers are just taking even longer, to approve things and to get deals out in policies in people's hands. So, definitely don't sit on insurance today and expect it just to bump up a couple $100,000 at renewal, because you might get, a really big surprise that I've seen a lot of people.
Yeah, that's certainly what we've seen. And I hadn't really thought about the residential side. So was California regulated where they had to get approval from the state to raise the rates by that much?
So the way I understand it, on the regulatory side, yes, they're most certainly regulated against, like certain, I think they can increase a certain amount year over year without really getting approval. But, if you were going to jack everybody's insurance rates up 30-something%, you got to get approval. But the reason it happened was just to keep that insurer in the state. And that's something we've been seeing a lot of, right? I mean, you'll just get insurance companies that say, hey, you know what? We're done with Florida. We're gone. We're out. We no longer insure in the entire state. I've seen it happen to several people, right? I mean, what do you do? I mean, they don't have to stay there. They can leave, right? That's why those premiums were jacked up 30% year over year, just to keep, an insurance market in that state. So that's gotcha. Really the level to where things are today. And yeah. I don't think it's going to slow down. I think we're going to see some pretty big increases here going forward.
Yeah. Is commercial largely less regulated, at least on what they can charge for, call it multifamily, industrial, the investment grade assets?
Yeah. I mean, it's still regulated, right? I mean, but anything consumer is always much more regulated. In commercial, of course, is a competitive marketplace, right? And there's a lot more ways to skin the cat in commercial property insurance there is in residential. You get some pretty uniform policies in residential. But, I think anytime you see, insurance policies in any asset classes get raised that much, it's going to filter through the market, because just the nature of insurance, right? I mean, is risk transfer. I mean, it's just going to hit everybody to a degree.
Yeah. No, at least I hadn't really thought about just pricing. I mean, residentially, real estate prices are up 20-30%. So that, it makes sense that just replacement cost, that's went up 20-30%. The challenge is on commercial with interest rates going up. I mean, some of the values have been stagnant or probably dropped from the peak. And certainly from the peak of 2021 to deals we've seen this year. I mean, there's definitely properties trading 20% below the peak, but in some cases, sure, insurance has went up 20%, 30%. And that's part of the reason the values have dropped too, is, commercial being so much more tied to cash flow and net operating income. So sure, it's kind of a double whammy for commercial owners.
I think the value add equation has changed to a degree, right? Because I think before a lot of this happened, the majority of value add was based around revenue growth. But I think one of the large components of value add going forward is going to be expense side mitigation. figuring out better insurance or, like, I don't know, utility costs and stuff like that. That's what everybody we do solar as well, right? Yeah, I mean, it's like every expense side input cost is going up. So, if you can mitigate your utility costs in some way, more efficient, toilets or something in your building. I mean, all of that stuff, that's real money in the bottom line if you can get rid of expenses, right? I mean, you don't necessarily have, if you find a property that's just getting killed with expenses, you can fix those. You don't necessarily have to, raise the revenue side that much. I mean, you can still increase your NOI pretty significantly if you can figure out the expense side. So I think that, because of all this input and expense side inflation, I think that's going to be, good value add strategy going forward. And taking advantage of whatever programs you can, right, on the expense side to try to mitigate those.
Yeah, that's a really great point. And we're on our second deal. It's a version. It's not technically a LIHTC deal, but it's a version of a partnership with the city of Houston where property taxes are abated by 80%. Texas is a property tax is a very big component of the expenses in Texas. And, it's there's limits to rent growth. I think we actually have to lower rents by 2%. But, in this market where there's, potential recession, some supply coming on market in the next couple of years, it's nice not to have to go into a property where we're going to push rents.
Yeah. And I mean, listen, as far some of these markets, like, that you were saying earlier, got overbuilt, right? You may not be able to model much rent growth at all, right? I mean, how do you model rent growth in a building that, has been renovated in the past 10 years and is at 90% occupancy in a market where, there's a lot of supply? You can't really, right? So if you want to, appreciate this investment in some way, I mean, you got to figure out, do it somewhere. And really that just comes down to expense side of things.
Yeah. No, it's in a way it's healthy for the market. I think there's a little bit of irrational exuberance in 2020, 2021. And, I think my hope is we're just back to a slow and steady, stable market where you just get back to the basics. And, hopefully over the next 5 or 10 years, everything just kind of works itself out. The supply will come back to equilibrium. The rates will do whatever they're going to do. I mean, I do think inflation is just going to be ongoing. I think it's the lesser of two evils. And, frankly, I don't know how the government pays its debt otherwise. I had a guest on last week because, really gave a great thesis on Bitcoin. And you really, the only real path is to essentially monetize the national debt and rates stay below GDP growth. And, over 10, 15 years, 36 trillion just won't be that much money.
And yeah, there's a couple ways to get rid of debt, right? And inflation's one of them. They'll make that debt worth less, for sure.
Yeah, and as rates come down, I mean, I think hopefully most people, have learned their lesson on the variable rate debt, and if rates get into the, what's that, the 5 years in the, I don't know if it's 3.6. I haven't checked it this week, but historically that's like a pretty reasonable interest rate, and so and then 3.6 the 5 years at 5 something.
3.6% 10-year is, restrictive to the economy. I mean, if you can't make money with the, the index at 3.6%, come on, maybe you shouldn't be in that deal. But that's the problem, and how all these people got stuck before, right? I mean, there was free money out there. I'm calling it was free. And in fact, I think it was, based on where inflation was, you were getting paid to take money, right? If you're only paying, a couple percentages on your loan and inflation's 4%, that's kind of free money. And there was more money than deals out there, and you could just slam through these deals, but they needed, almost 0% loans to work out. And that's just not how it is anymore. The problem we have right now is the inverted yield curve, right? I mean, short-term rates need to come down. Long-term rates, 5s and 10s, have come down with the expectation of rates coming down, but you've still got super high short-term rates. And, that type of financing is completely predicated on short-term rates, short-term lending, construction, bridge lending, stuff like that. A lot of acquisition deals are done with, loans that are priced over SOFR or funds. And a lot of these, and a lot of bank lending, the way they pull money, they have to basically charge Fed funds plus or minus something for, the front end of their deals in construction. So that's really what's constraining, a lot of this market is the super high short-term rate. And that'll come down, right? That'll come down over the next year, hopefully in September here, like Paul just said. But, I think as soon as the short end starts to come down, that's where we're going to see things really take off.
Yeah, I hope so. And I've even seen a few of the deals we've looked at. There's kind of a unique structure where they're taking a variable rate loan, but they're basically prepaying a bunch of points, but it's through through buying an interest rate cap. So they're essentially buying an in the money option, whereas, SOFR plus 3, I mean, they would have had like an 8% rate, but they're basically financially engineering a 4.5 or a 4.75% interest rate. But if rates drop and they refinance early, they get a huge refund of that interest rate cap. Right. They're engineering 3-year fixed without a prepayment penalty. And if they do refinance early, they get back a bunch of that prepayment money they've essentially prepaid on their 8% rate.
Right, we did a deal like that too, right? Where without the cap, I think it was something like a 9 coupon. We were able to buy a rate cap. I think it cost a 1.5 with I think like a SOFR cap of something like 4 or something like that, or 3.5. And I mean, the optics of what you were actually paying on debt service was phenomenal, right? I mean, if you're capping your SOFR at 3.5. No, I mean, that's definitely an interesting way to financially engineer a lower rate for yourself.
Yeah. So you obviously got a lot of programs across debt, equity, the insurance side. What are we've got a lot of passive investors listening, but maybe some operators, maybe some investors as well. What are some of the key programs where, you're either most competitive or you've really helped investors? There's programs, what comes to mind where it's like kind of your optimal programs or the ideal potential borrower that you could help?
Yeah. I mean, I think, the best way to look at us is like a service provider, right? And I think the thing that we do exceptionally well and better than anybody else is really putting the grunt work into like appropriately approaching the bank market. If you've ever done a deal and tried to finance it through banks yourself, I'm sure you feel the pain here, like just even trying to get people to call you back is pretty difficult. But we've been doing this for 16 years and I don't think anybody else could say this, but we're able to reach out to in any market in the country, put together a capital market of bankers at local regional banks and reach out to them within about 24 hours and start getting term sheets in a couple of days. Here's a good example. For one deal we did in Tulsa, I believe we talked to over 500 bankers in that deal. And I just don't see how it's feasible for somebody who's syndicating a deal and trying to run a property to run that type of process to find, the most efficient financing. I mean, you just don't have that amount of time, right? And I think that's one of the things that we do exceptionally well, is finding, very, very competitive, terms because of great capital markets we're able to put together each time. And it's customized each time. Another thing I think that's one of our competitive advantages is having an in-house insurance company. That's why we started it, because when we get into a deal, we have saved several deals, several financings because the insurance side has stepped in and found the right policies and lowered the premiums and, made the debt service work and stuff like that. So being able to like work hand in hand with that in-house is such an advantage to trying to get deals done. And also, when we're dealing with, acquisitions guys or anybody that's going out and looking at a property and they want to like appropriately model what their returns are going to be. I can tell them what their cost of capital is going to be, what their insurance costs are going to be. It's a huge advantage, especially for our clients going into any deals.
That's that's great. That's someone who's in the business on the equity investor side. I know how valuable that is to the operating partners when we're trying to underwrite.
Having real-time data is huge.
Yeah. I mean, we had a deal in Houston that was a HUD assumption. And fortunately, we had it out in the contract, but, insurance had more than doubled per door and didn't realize it till pretty far into the HUD assumption process because HUD was requiring a higher amount than the prior borrower had. I guess on the assumption they were basically changing the terms and it changed the policy and it ended up killing the deal over it on a 2.8% assumption. It was a deal we really wanted.
6 figures. So that's real.
Yeah. Yeah, absolutely. Well, Jake, really, really great stuff. Dropped a lot of knowledge, a lot of value here. Tell us how we can get a hold of you.
I am exceptionally easy to find, Jack. On LinkedIn, you can always find me on LinkedIn. Our website is cloptoncapital.com. Just call me directly. I'm always around.
Great. And we'll put all that in the show notes as well. Well, Jake, great conversation. Thank you so much for being on the show.
Thanks so much. Appreciate it.
All right. Bye, everybody.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.